All right, today we're digging into the latest results from ABR Holdings. Now, you probably know them best as the company behind Swensen's, and their 2025 numbers, they tell a really fascinating story. It's one where they're selling more ice cream and food than ever, but somehow they're making less money. So, let's get into it and find out why.
Okay, let's jump right into the headline figures, because this is where it gets interesting. On the one hand, you've got revenue. That's the total cash from all their sales, and it's up a pretty solid 5.5%. But then you look at the other side, at the actual profit, and it's down over 12%. And that is the central puzzle we're here to solve today. How does a company sell more stuff, but end up making less money?
So to figure this all out, we've got to start with the basics. First up, we're going to take a quick snapshot of the company's finances, just to understand the key players in this story: revenue, costs, and, of course, profit.
Now, when you hear ABR Holdings, most people immediately think of Swensen's, right? And that's totally fair. Their main business is running those iconic ice cream shops and restaurants. But, and this is a big but, they're actually more than just that. The company really operates in two main areas: their primary food and beverage business and a growing property investment arm. Definitely keep that second part in mind because it becomes really important later on.
So, let's put some real numbers on the table. As you can see, revenue jumped up nicely to $143 million. But here's where the plot thickens. Take a look at gross profit. That's the money they have left after paying for the food and ingredients. It's completely flat, barely moved. And that problem flows right down to the bottom line, where the profit for the year actually fell. So you got to ask, what is happening between that big revenue jump and the drop in profit?
Okay, so let's start with the good news. A 5.5% revenue jump doesn't just happen by accident. So where did that extra money actually come from? Let's break down their sales numbers and find out.
Well, the reason for the growth is actually pretty straightforward. According to the company, it's almost all thanks to opening new restaurants. They opened some in late 2024 and then more throughout 2025. It's simple, really. More restaurants meant more customers, and more customers meant more sales.
Now here is a really crucial detail. When you look at where that $143 million in revenue comes from, it is virtually 100% from their food and beverage business. That property side of things, it's not really generating external sales yet. This tells us one thing loud and clear. As of right now, the entire financial health of ABR Holdings rests on its restaurants.
So if the restaurant business is bringing in all this extra cash, that leads us right back to our original question: where did the profits go? And to answer that, we have to look at the other side of the equation, the costs. This chart right here shows the whole problem in a nutshell. While the revenue grew by 5.5%, the cost of sales, so what they spend on things like ingredients and direct labor, it grew almost twice as fast, at 9.6%. This is what investors call a margin squeeze. The gap between what they're spending and what they're earning is getting wider, and not in a good way.
So, what's behind this cost explosion? Well, the report points to kind of a triple whammy. First, the cost of food ingredients is going up, inflation, right? Second, they had to hire a whole bunch of new staff for all those new restaurants. And then on top of all that, their administrative expenses, the cost of running the main office, also jumped by over 12%. It was just a really tough year for costs all around.
And a report sums it all up with this one really powerful number. The gross profit margin fell to 40%. So what does that actually mean? Well, it means that for every dollar of ice cream or food they sold in 2025, after paying for all the ingredients and the kitchen staff, they were left with just 40 cents. The year before, that number was higher. So their main business, it actually became less profitable for every single thing they sold. That's a huge trend for any investor to keep an eye on.
Okay, so profits are getting squeezed, we get it. But profit is really just an accounting number. For an investor, what often matters even more is cash. Does the company have the actual money to pay its bills, to pay its employees, and to invest in the future? Let's follow the cash and check on ABR's real financial health. Okay, this is a simplified look at their cash flow. Just think of it like the company's bank account for the year. So in step one, their main business, operations, selling food, it brought in a very strong $25.8 million in cash. Then in step two, their investing activities, which can include things like selling off some investments, actually brought in another $4.7 million. Then you have step three, financing, which includes paying back loans and paying out dividends to shareholders. That used up about $21.9 million. So, what's the final result?
The final tally is a net increase of $8.6 million in their cash reserves.
And this is a really important piece of the puzzle because it's the total opposite of the profit story. While their accounting profits were down, their actual cash position got way better. They ended the year with more cash in the bank than they started with. From a financial stability point of view, that is a very, very positive sign. It shows the business is still fundamentally great at generating cold, hard cash.
And it's really worth pausing on that cash from operations number for a second. This is the absolute lifeblood of the company. It's the actual cash that comes in from selling all that ice cream and food. The fact that it's nearly $26 million, even with costs going up, shows that the core restaurant business is still a very powerful cash machine.
So we've got this kind of split picture, right? A profitable, cash-generating F&B business that's facing some intense cost pressures, but at the same time, a strengthening balance sheet. So what does all this mean for the future? In our final section, we'll look at what the company itself is saying about the challenges and, maybe more importantly, the opportunities that are on the horizon.
And the company is being very honest about the situation. On the left, you can see the challenges, the F&B headwinds they expect to continue. High operating costs, a tough market to find workers, and tons of competition. These are the exact same things that squeeze their profits in 2025. But on the right, you see the other side of the story, the opportunities in property. They're specifically calling out two huge projects, Pavilion Square in Malaysia and a brand new land parcel at Dairy Farm Walk in Singapore.
And this isn't just some vague idea. They have been actively building up this side of the business. This timeline shows a really clear progression. The Pavilion Square project in Malaysia started kicking in late 2024. A joint venture residential project in Singapore was completed in the first half of 2025. And then, just after the financial year ended, in January 2026, they won the bid for another big project at Dairy Farm Walk. This shows a very deliberate and growing focus on property development.
So, here's the crucial point. The company seems to be following a really clear strategy. While they're working hard to manage all the challenges in their main F&B business, they are, at the same time, steadily building up their property segment. The profits from these property ventures are what helped prop up the bottom line in 2025, and it looks like they are doubling down on this approach. It's a classic diversification play, trying to create new and hopefully more profitable streams of income.
And this really brings us to the final, big question for any investor looking at ABR Holdings. On one side, you have this beloved cash cow F&B business that is facing some serious margin pressure. On the other, you have a growing property development arm that's starting to make a real difference to the bottom line. So the big question for the next few years is all about balance. Can the growth and profits from their property ventures grow fast enough and big enough to offset the challenges in their core restaurant business? That is the strategic puzzle that will define ABR's future.
This content is intended to serve strictly and only as an informational, independent, objective summary of recent events and should in no way be interpreted, construed, or relied upon by any party as inside information or financial advice.